Hello and welcome. You're with Echelon. Thanks for joining us this afternoon from wherever you are. We're here to talk about portfolio strategy for 2022. This is part of Echelon's Investor Guide 2022. And 2021 has been a bit of a roller coaster. I think for what we've seen in the economy, what businesses and people have experienced, and what the markets have done have diverged sharply. As we are recording this, the market hit a record high, and that's been momentum that has been gathering for several months now, right? There are, however, fears about what awaits Sri Lanka's economy in 2022 with over $5 billion in debt repayments coming up, and talk about the potential or the need for restructuring Sri Lanka's international sovereign bonds because of the way they are bunched over the next few years and the potential difficulty in servicing that without disruption, right? So thanks for joining us. We are going to talk about all that and about how assets are likely to be impacted by the macroeconomic conditions in Sri Lanka, and the two assets we are particularly interested in is equity and also fixed income. We'd like to see if our panel has views on real estate. Maybe they do. Let's ask them. And let me quickly introduce the panel to you. You may already know this, and in the capital markets, these are three people that lead and don't need much introduction, really. The first is Lakshini Fernando. Lakshini is from Asia Securities. Then we have Sanjeeva Fernando. Sanjeeva is from CLSA. And last but not least, Udeeshan Jonas from Capital Alliance. Welcome, guys, and welcome to all of you. Please feel free to put your questions online. We can take them up as and when they're relevant to the conversation, and if we haven't taken any up by an hour from now or 45 minutes from now, we'll possibly take all questions on a rolling basis, right? So do put them out early, and I'll possibly talk to the panel first and ask them for their opening comments. This is maybe you can take maybe 2 minutes, Lakshi. I'll ask you to start. What do you like to put on the table to start with?
Right. First of all, thanks Shamindra and Echelon for having me on this panel. I think it's a very timely one going into 22. Look, I think taking stock of 21 and what's actually taken place, going into 2022, there are some positives and negatives, right? But where we are sitting right now, it looks like the negatives are outweighing the positives. I'll just talk about the positives first of all, right? I mean, I think we've got to give due credit to where it's worth, and the vaccination drive in Sri Lanka, I think, has been quite good, with almost about over 60% of the population vaccinated, booster shots being administered. Given where our healthcare system is, I think that was a key need of the hour during the COVID pandemic, and I think the government's really taken up on that. Tourism has picked up much faster than we initially expected as well, and it looks like December is also going to end quite strong. Going into 22, I think I can't see this changing too much. And overall, look, in terms of economic activity, economic momentum, given where the vaccination drive is and everything, it's very difficult to see complete lockdowns going into 22. So I think in terms of economic momentum, you are going to see it continuing this upward trend that we've seen going into January and the first quarter. But there are obviously some, dark clouds that are around. And I think first and foremost is, and everyone talks about it, our external debt repayment schedule, right? We've got 1.6 billion in reserves right now in the bank. We've got, 5.4 billion of repayments. So where, that sort of is going to come is the question. The central bank has put out in the roadmap as well as an update at the end of October that they do expect about 2.6 billion to come in. If it comes in, great, but I think timing is key. Then, you've got the currency, which, has been quite stable, but I think with the divergence of the rates in the bank official rates and unofficial rates, I think there's got to be some correction that's got to be factored in. That as well as, you've got inflation. Yes, it's global, but I think locally with the fertilizer ban, it's kind of exasperated a bit. So you've got those, going in. And I mean, one of the other conversations we've always had is, what is going to happen with our repayments? Is the IMF in, is the IMF out? I know we'll talk about it extensively, I'm sure. But what I can say right now is I don't see a default at play next year, but there has to be some restructuring at play. I'll close off on those initial remarks.
All right, thanks, Lakshmi. Udeeshan, let's go to you. Again, take 2 minutes. Tell us, this may be enough time to put 1 or 2 points across, good points. What do you think is the outlook like?
Thanks, Shamindra, for having me. As what Lakshmi mentioned, I think the biggest concern for this year is the external debt repayments. And Sri Lanka has come to a position where we're only down to about $1.5 billion in terms of reserves, and our debt repayments are about $4.5 billion, of which roughly about $2 billion or $1.5 billion is sovereign debt repayments. And to meet this, we do not have sufficient inflows coming at the moment. And even though central bank has a roadmap in place, we still haven't seen much of it materializing. And the main issue is that it's not a one-off problem. We have the $4 to $5 billion debt repayments for the next 3 to 4 years. So just having a short-term plan is not going to work out. So we need those structural changes, and this is the year that we will have to do that if we were to put back Sri Lanka back on track in terms of a steady economic recovery path. So from a monetary policy perspective, I think interest rates have been in low single digits, and that was also because of the unprecedented level of monetary printing that the central bank has been doing. We've printed almost about 1.4 trillion rupees of central bank assets. Assets have gone up by 1.4 trillion, and this has also led to interest rates coming down, but it has had its impact on inflation, even though we've had supply side constraints and global concerns raising inflation. The demand side of things has also played in. So the monetary printing has also led to excessive amount of inflation. So it's a situation where we're seeing both supply side and demand side inflation, particularly in Sri Lanka, which is why our inflation levels are at about 9.9%. And we see for the next couple of months, inflation is still going to be on the upward trajectory. So from a central bank perspective, we feel that the central bank will also be taking a more tighter stance, a tighter monetary policy. And they've already started the process. So we've seen in August, rates have been increased by 100 basis points. We've seen SRR being increased. So we feel that will kind of continue. And also globally, that seems to be the phenomenon, especially the US indicating that Fed will start tapering starting from November, where they will bring down their bond buying program to from 120 billion to basically zero in a couple of months. So all this will mean that we might see a more tighter monetary policy stance for the next 12 to 24 months.
Okay, so we'd really like to talk about the impacts of all these on assets as we go along. But Sanjeeva, cutting over to you, initial thoughts to get us started.
Yeah, so thanks for having me, Shamindra. So I do agree with Lakshini and Udeeshan about the comments they made. So we do have a challenging external environment, and that is essentially tied to our debt repayments. We have development bonds to be paid immediate near term, and then sovereign bond payments coming up. And then inflation is on the rise. I mean, if you look at staple consumables, they are in high double-digit zone. And then you have money printing also giving price pressures here. There are not much demand pressures as of now, with credit growth falling to around 13% from as high as 15% in August after the central bank policy tightening. But we do see liquidity of the financial system coming down significantly, which means come first half of next year, you will see financial institutions jacking up their deposit rates to compete for deposits in order to do their regular business. So that may also mean there will be continuous upward trajectory in interest rates. Now, exchange rate, I mean, we do have 3 rates right now. We have an official rate of 203, we have a grey market rate of 233, which is 15% down, and then we have a black market, which is always there, but not at these levels, like 20% down for the black market and all that. And because of the dollar shortage, most of the companies will have to use some of these markets, which on paper is relatively different from what we see in policy documents. So that I guess the monetary authority and technically the authorities are trying to bridge these gaps. They do understand these markets, the existence of these markets. So I guess that's the challenge going forward. So I mean, if you have to do a restructure of debt, you will have impairments coming up, or then a requirement of capital for certain financial institutions, if that is the case. I mean, in definition, I mean, according to the definition of some rating agencies, a restructure also means could also be a default. So then you will have rating downgrades also coming further. So these implications could be there. So let's discuss further.
So just to get some basics out of the way, right? We're talking about restructuring. We're talking about default, right? By default, I guess we mean we hit a wall and then we don't pay, right?
Essentially, to come in July and be like, oh, sorry, but we were not paying. So what I said is I don't think that will take place.
That will take place. But I think everybody around this table agrees that the international sovereign bonds or the commercial debt that Sri Lanka holds in large part needs to be restructured. What does that mean for the rating? Does it mean that we go to a D rating just because we restructure? So as long as for the rest of the conversation these basics are clear. Udeeshan?
Yep. So when you say the position we are right now in, by July we will have an issue in terms of paying the $1 billion. So we have two options. One is we go for a hard default and say no, we can't pay, or second we take the route of the IMF, which can take two forms. One is that if the IMF feels that your debt is more sustainable, you might be able to get hold of an EFF facility or extended funded facility, which can be somewhere around $2 to $2.5 billion. And on the back of that, because of IMF coming in, the credibility might bring in your bilateral lenders also back into to give you more loans. So that is the best possible option right now. If the IMF doesn't think that the debt is sustainable, and if they feel that the kind of primary deficits that we are running right now is not something that you can reverse with normal fiscal reforms, that means that we might have to go in for a restructuring. And a restructuring means that you will have to take haircuts on your bond positions or the sovereign bond positions, or it could be a way there is a postponement of payments. So it could be a mix of both, like what we've seen across the region in the recent past.
Okay. How does it work for you guys as far as when you're doing your forecasting for 2022? How do you work this in? I'm assuming then that you're not looking at like us walking away from our debt obligations necessarily, right? You're looking at restructuring. How does that impact your ability to forecast? Because we have this fairly unusual situation.
Yeah, for sure. I think this has been one of the toughest years, for sure, to forecast and predict what's going to happen in 2022, which is why we pretty much went on a scenario basis. So look, I think the way where we are right now, the government pretty much has two options, right? Either go to the IMF or manage on their own. And if you look at the government commentary, central bank commentary, it's very positive towards managing it on their own. But the reality of it is some of the funding that was expected, I think, is delayed. So if that takes place, so assume they do manage some state-owned enterprise sales, they do manage some PPPs, they manage some government-to-government swaps. It's literally buying time, Shamindra. So I think how we've gone about it is, okay, what will the scenario be if the IMF comes in? again in 6 months' time? What will the scenario be if the government tries to sort of manage this entire situation on their own, which is a bit of a sort of harder, route towards going and meeting all these obligations?
Sanjeeva, you want to weigh in on that, right? And this is a specific question I'd like to pose to all of you. Right? Liquidity tends to inflate asset prices. So, what impact do you think the current level of liquidity, or the level of liquidity we've seen in the last 1 year almost right now, has had on particularly equity?
So yeah, I mean, we have three markets essentially in Sri Lanka: fixed income, equity, and then property. Interest rates were so low that the fixed income market did not attract much funds. And then the property, there was a notion that property was kind of overvalued relative to what it was. Obviously, the relative to the prices we saw probably in 2013 and 14. And so I think, it requires cash in hand, and then people's mindset to believe that, it's again the time to buy into property. So then whatever, again, as Udeeshan indicated, we have like massive money printing coming in, as we can see through, there was around 1.3 or 1.4 trillion worth of money printed from the onset of COVID. And this year itself, I think it's around 700 to 800 billion rupees worth of money printing. So, and then if you to look at the production per se, from a GDP point of view, I think we have not grown above 2018 figures. So that means, you still have the, lot of money chasing behind a smaller production phenomenon coming in, which will lead to prices going up.
So I'm bringing you in, Udeeshan, on this same thing, right? How much of this current, asset prices are due to the liquidity? If now let's look at the possibility, if there is a tightening, if the IMF comes in and there's significant tightening, what does that mean to asset prices?
So at the moment, I think most of the printed money has flown into inflation, equity movement. When I say equity movement, if you compare where the market cap was 2 years ago or 1.5 years ago to now, the market cap is increased by about 2.5 trillion rupees, which is equivalent to about each person in the economy having about 140,000 rupees. So money has found its way. It's just that the top players have seen have been able to secure a large part of the liquidity, which is why we are seeing the corporates doing really well. So the corporate earnings have kind of supported that with the money flowing into that component. But what I feel is that moving forward, or looking at the next 12 months, if the current situation continues, and given that supply constraints are still prevalent, and economy is starting to kind of to recommence operations in full force, I feel that inflation can even move further. But if the central bank kind of comes and kicks in and starts increasing rates, or even pulling back the amount of printing that they've done, you might see the equity markets taking a breather. And this is the phenomenon that we are expecting not only in Sri Lanka but across the world. So even the S&P 500 has overinflated, and global investment banks are expecting a retrieval of these markets. So similar kind of phenomenon can happen in Sri Lanka, but it will depend on to the extent and when the central bank reacts. So if the actions are not taken now, you might see markets even moving further, and that could mean that you might see equity market movement in the initial couple of months, and then when central bank starts responding, the impact to the market will be probably 3 to 6 months down the line.
Right. So
actually, just to add to that as well, I think that's a really good point, because if you see how the markets work, especially if you look at corporate earnings, right? Say you take the manufacturing sector, for example, import controls have really set up the stage for these guys, right? So say in the absence of the IMF, say at least in the first half of the year, you're looking at certain sectors continuing that momentum, and also that spilling into the equity market. Because at the end of the day, right, Shamindra, everyone's looking at how to beat inflation. Your real returns is really what matters. And I think that's the phenomenon next year as well. You're going to look at the key cycles, and that's your rate cycle, your inflation cycle, your currency cycle. And I guess positioning is going to be based on that. So I completely agree. I think equity market may see a pullback, if the IMF does come in and put in these restrictions. But at least until it does, I think there's still a bit more to sort of go in terms of finding that real return.
Okay, so I understand that you can try to forecast earnings growth or earnings, but it is difficult to predict where the index will go. And I think over the last year or so, the market index has doubled approximately, right? Should there be tightening? What sort of an impact are we looking at? Are we looking at it? Will it be marginal? What level of tightening will be required of us, and what sort of impact will that have on the index? Can I ask you to start, Sanjeev?
Yeah, so let me add a point to what Lakshini and Udeeshan said. I mean, we are anyway going to rebase the stock market from next year, so that's going to be liquidity adjusted. Yeah. So you won't see this kind of increases based on the increases that you see in relatively liquid stocks. But yeah, so I mean, from a monetary tightening point of view, I guess whether they may have to jack up interest rates will be a question for them, because right now liquidity is drying up. So that, I mean, banks will have to offer better deposit rates to attract liquidity. So I think central bank may not have to tighten policy rates, at least probably maybe let's take it by a month. I mean, by next January they may not have to increase.
Let's get some quick comments. Should there be an IMF involvement and tightening of the deficit, right? Yes. Higher taxes, lower spending, less liquidity. What impact will that have on assets given where they are currently?
I think yes. Okay, purely because right now things are a bit unsustainable. If reserves were stronger, I would say no, because then the government has a bit of leeway. Where I see things right now is that, our options are very minimal unless some strong funding comes in, Shamindra. So if that comes in, then I would say, look, they may be able to manage it, get the rating up at some point, and that may support things. But where we are sitting right now, I think an IMF requirement from a macro standpoint is required. But either way, I think even if the IMF doesn't come in, one thing we definitely know are the cycles that I spoke about, right? Rates will be an upward trajectory. Agreed, it may not be as fast as what we expect in some of the regional peers, but because the government also has this, and the central bank have a sort of initiative to support growth momentum as well. So they can't raise rates significantly higher. But I think a tightening policy measures are required next year. That's in the cards, and we expect it at least 100 basis points. If the IMF comes in, it's probably going to be more than that, because the IMF would have those sort of regulations to come into play as well.
100 basis points over the full year?
Over the full year,
so minimum. That's 1% over the full year. What do you think, Udeeshan?
I agree with what Lakshmi says, but my view on the policy rates, it might be slightly on the high end, 100 to 150 basis points. But in terms of retrieving the amount of printed liquidity, I think it's impossible to do it overnight, and it's going to take a very long time, given that we are funding our deficit with pure domestic sources at the moment. So it's impossible to kind of wipe off that entire liquidity overnight, or even over a period of 6 months. So it has to be a gradual process. And the other important thing is that our import bill, which is now at significantly high levels, needs to be retracted. So that will need the support of the tightening monetary policy as well. So given that we don't have the reserves in place to kind of defend the currency, one way we could tackle the import bill is through the monetary policy route.
Okay, staying with you, just for some context, calendar year 2021, that is this year, what do you think earnings growth was in the market-wide?
So for 2021, so if you look at the last quarter, earnings were up by about 45%. If you do a cumulative for the 9 months, we are looking at roughly about 60 to 65% kind of earnings growth. But I feel that December might be slightly lower. But this growth is not going to continue going into 2022. I feel that by March you might see a bit of slowdown coming in, and that's also because of, one is the higher base, and second is the fact that the consumers are feeling the wallet pressure, and that's going to start reflecting in the numbers very soon. And the current growth in terms of earnings is also driven by the pent-up demand. The demand which was missed in the last 12-14 months. People have been using their savings, they've been happily kind of spending over the last 6 months or so. Once the savings kind of runs out or that kind of comes down, you might see that impacting on the corporate earnings growth.
Right. So what's your forecast then for 2022? What do you think? Let's look at calendar year just for simplicity, or approximately earnings growth of what?
So earnings growth, I believe, will be more or less flat. I'm not expecting a growth in terms of earnings next year. And it's difficult to pass on costs in this kind of environment. So your margins are also going to take a beating. So not much of a growth this year.
What do you think, Sanjeeva, 2022 earnings?
So I mean, once you exclude the logistics sector, you could have probably maybe, if, I mean, the best case scenario will be high single digit or maximum 15%, if at all. But I mean, just to add something to what Udeeshan said, I mean, if you have a scenario of restructuring or something like that, then you will have all these impairments coming up, and then asset write-offs and everything will result in earnings becoming flat.
Lakshi?
Yeah, I think, look, again, it's on a scenario basis, right? I think if the IMF comes in, corporate taxes will go up. You will see that sort of pain coming in, which we didn't see this year. If the IMF does not come in, I think there may be a bit more leeway. Also, if import controls continue, locals would definitely, some of the companies would definitely see some upside. The dollar earning companies would also see some upside. So I think there are the positives and negatives, but I do agree, I think it may be towards the mid-single digits, but there are opportunities. That's what I would like to focus more on.
Right. Since we are talking forecasts, can I stick with you and ask you also what you anticipate in terms of will happen with the budget deficit and also the rupee? Where do you think it'll land?
Tough questions. Look, I think given where we are right now, Shamindra, like I mentioned, I think there has to be a depreciation factored in. It's very difficult to see not happening. And I feel partially that may come in, a partial bit of that depreciation may come in the first quarter itself, with the gradual depreciation taking place towards the rest of the year. On that basis, I would think the currency may hit at least 235 by the end of next year. But again, a lot of factors have to be considered. If the IMF comes in, it could be a steeper depreciation than that as well, because markets have to correct. This variance between parallel markets has to adjust. And that's why we think that steep depreciation may come in. In terms of, currency and what was it?
How credible is the budget as it stands
Budget,
right
yeah.
now?
Look, honestly, I was expecting a bit more of tightening measures, especially to increase the revenue base, because that is where we are really struggling. I expected a few more additions in terms of taxation and whatnot, because I think going into 22, it's looking quite tough. Yes, the government is trying to reduce their expenditure, and that is a key positive. And they also expect sort of this higher economic momentum to bring in more volume. But where we are right now, given, you are going to see upward growth at least 4 to 4.5% next year, you're looking at the budget deficit steepening a little bit. So I would think it's actually at least going to be about 10.5.
Let's get you in also, Udeeshan. Rupee, this is what everybody wants to sort of figure. If, assuming there's restructuring, right? That's the scenario we are all discussing here. What do you think the rupee will be, and how credible is the budget?
So on the rupee, my view is that irrespective of whether you're going to restructure or not, the rupee needs a correction. If you look at your worker remittances now, last month remittances were down by about $300 million, and worker remittances is the largest component of income, FX income to the country. If you continue to lose that burden itself is about $3 billion. So having this parallel market doesn't work. So we need to make that adjustment right away. And I feel that the central bank will also be tilted more towards it at the beginning of the year. So my view is, I share Lakshini's view in terms of the where the currency should settle. So we are looking at about 230 to 240 rupees to the dollar. And if you look at all countries which have gone through a restructuring or at least a potential default, most of them have seen significant depreciations of the currency just ahead of a typical cycle.
And do you feel there is a credibility gap in the budget as it stands right now?
So in terms of deficit, the revenue measures were not sufficient. I feel there was only two main tax sources that the government was targeting. And they are looking at about 8.8% deficit to the GDP, but that was on account of a significant increase in public investment spending. From my perspective, I feel that the government will claw back on the public investment spending like what they've done in the past. So obviously they've been spending only about 50 to 60% of what they normally budget for as public investment spending. So that means that still, even though your revenue is less, your deficit will still be about 9 to 9.5%.
Thoughts on the budget, currency?
Right. So currency, I mean, okay, if you asked us 6 months back, we would have said kind of it requires depreciation. And for last 7 months, it has been kept fixed. And you have this economic theory called unholy trinity, right? So you have a fixed exchange rate and you have an autonomous monetary policy. You have to stop or you have to add capital controls. Now on paper we say as in the central bank says that they allow free capital movement, which cannot be the case. So I guess you have to understand the reality, and that means capital controls. If you want capital controls to be there, then yes, you can continue this fixed exchange rate, and otherwise you will have to let it depreciate. So I mean, I really don't know what they will do, but what I can say is you can't challenge proved theories. So yeah, I'll stop there for the currency. I do agree with Lakshini and Udeeshan on the exchange rate forecast, but the point is we really don't know what they will do, because I mean 7 months back we thought they will allow it to correct and kind of kept it fixed, and now we have created a grey market which is 15% below you. So even if you offer 10 rupees to encash $1, no one will encash dollars because you get better rates in formal, I mean relatively formal markets. So yeah.
What sectors or companies even do you think are the most exposed to this challenge, this macroeconomic challenge currently, right? Are there clear ones where you think this hasn't been priced in necessarily?
Look, I think the pain points even this year, Shamindra, has been for the companies that import their raw materials, right? Sourcing dollars, opening LCs has been, challenging to say the least. So until that dollar liquidity sorts itself out, until the banks are able to open proper LCs, I mean, even as simple as, I know people who've gone overseas who can't use their cards. So, I mean, unless those sort of things get sorted out, there will be definite sectors that get impacted, and I would think it's mostly those who are importing their raw materials for sure. Currency depreciation, again, it will be those who import their raw materials because they'll have to take a hit on the currency when that does happen. I also agree. I don't think it's an if. I would think it's a when that currency depreciates because, we don't have the reserves to support a currency like this.
Several extraordinary taxes were introduced in the budget. There's a 2.5% tax on revenue, right? What sort of an impact do you think it'll have market-wide? What sort of a number are we looking at here?
That's actually difficult to say right now because it's not very clear as to who gets. I mean, I'm sure Udeeshan or Sanjeeva can actually talk a bit more on this, but the way I've seen it, it's not very clear, anyway for the corporates as well, as to who will actually get taxed on this. And I, from what I understand, they're also awaiting a bit more details on this. So just like Udeeshan said, the government is expecting to collect a colossal amount through this, but at the end of the day, we also need to make sure that the sort of the deals are there to know who is actually eligible to pay this or not. It's a one-off tax, but right now I can't really say too much because I don't think it's very clear at the moment.
Udeeshan, what do you think? It's
I think it's not stated clearly, but the government is looking at collecting about 100 billion rupees. That's what they mentioned in the budget. But we still don't know whether the banks have to pay the social security levy of 2.5% and also pay the higher VAT, whether that is applicable. So there's a lot of grey areas that need to be sorted out first. But still, the underlying thing is that it's still not enough in terms of the amount of money that's raised.
Yeah, I mean, for me to add a point there, I mean, I guess we had nation building tax up to 2019, right? So then it was on revenue, right? So then you had retail companies being charged at 1%, and then banks charged on their value added, not on the revenue. So this also could probably have similar aspects, but they have to give more clarity on it, because how they are going to raise this 140 billion, they have to be clear on it. Because now for the surcharge tax, they have indicated 62 companies, you know who's paying and you know how much they're paying. So I guess, but overall we are still not looking at 100 billion from surcharge and 140 from social security levy. That's still less than $1 billion. I mean, if you look at a fair value currency, right?
and can I ask you about where do you think the impacts of the current macroeconomic challenges will be reflected in terms of listed companies? Which sectors do you think are likely to reflect these, and maybe even which ones are not likely to reflect these?
So general consumer spending will get impacted because of price pressures. So anything, any company who's, who wants people to spend will have an impact. And financial institutions will figure out a way to pass it on to the consumer. That means interest rates again are going to go up, and that means you will have the thesis that we indicated before with regard to interest rates happening. So exchange rate will have the biggest impact. If it's depreciated, one impact. If it's not depreciated, another impact. I mean, still both negative, right? If it's not depreciated, you will have a illiquid market. You have to go to your gray market or the black market to get money. If it's depreciated, you will have the real impact coming through. These could be the probable impacts.
Staying with you, Sanjeeva, I'm just trying to reconcile the two, right? On one hand, you say 9%, maybe even 15% earnings growth in 2022, approximately, right? Excluding logistics.
And we do not go for a default, because which will not require impairments. Otherwise, I think Udeeshan was kind of referring to, we having impairment and then probably having flat.
Sure. At the same time, by what you're suggesting, several sectors that are important in the market, from financial services to consumer, are likely to be impacted by the conditions that are the storm clouds that are now gathering. I don't know if you have a clear how you're going to explain this, but how do you reconcile this? Earnings growth continuing, and financial services are impacted. There is this 140 billion in extra taxes that the government intends to collect, and then consumer goods companies also likely to feel the impact.
I mean, two aspects, right? It's in a way you have not impacted the general consumer by increasing personal income taxes, because anyway now they will have the inflation tax coming in. Both are taxes, whether we like it or not. So now, okay, you're taxing corporates who made money, which is also kind of okay in a way. Now, what you need to have is obviously discipline, which is not there.
Udeeshan, what are the chances that with an IMF program that VAT rates will have to go up from their present 8%? I mean, not so long ago we had 15% VAT, plus there was NBT and stuff like that, right? So we basically halved consumer taxes.
Correct. So the turnover form of tax which came in is indirectly kind of trying to do that. But if you look at all previous IMF programs in countries, example, Ecuador, when they went into a program in 2020, increased their VAT rates, were asked to be increased by 3%. And that's a kind of easier thing to do, and especially in a country where in low-income countries, low-middle-income countries, that's the easier form to collect taxes. So more than charging direct taxes, if you want to get your revenue up and to get that kind of quantum that you're looking at, like a 200 to 300 billion rupees, it is the turnover related taxes like the VAT, the social security levy taxes that we should be looking at. So highly probable in terms of happening.
So what sort of a rate increase do you anticipate will be required to be credible for an IMF program?
So I think VAT should at least move by about 5%, but it shouldn't happen overnight. So I think IMF also understands the phenomenon, because in challenging times like this, you can't expect economies to bear such a large hit overnight. And they will most likely give us a target to hit that number over a couple of years' time, and that will be gradual. But you have to stick to that plan. So it won't be today we have 8% and tomorrow it will go to 11 or 12%. It might be gradual in terms of.
Programs don't specifically target, say, okay, look, you need to increase VAT by this. They focus on the fiscal number. So it's the government's sort of plan to reach that. And I agree. I think taxes will have to go up and fiscal consolidation take place if the IMF does come in. That's a no-brainer. But I think the sort of tax increase will be gradual, because you've also got to sustain somewhat of a growth momentum while you're making your fiscal consolidation plans as well.
They've stopped micromanaging after the Asian financial crisis, I guess.
Okay, so let's take some quick questions also. There's one, since we're talking about the IMF, what do you think will be the trigger point for the government to go to the IMF? Why are they still resisting it? In the absence still of a credible plan, why do you think they're still resisting it? I mean, you can only opine on these things.
Yeah.
So we have $1,587 million worth of reserves as at 1st December. That's like 2 weeks back. We had, let's say, $1.6 billion worth of reserves. Out of that, 400 million is gold. So how much can you spend? 1.2. And we have a sovereign, we have a development bond to be paid to the financial system, $1 billion this month. Probably that will be, I don't know what is the word they want to use, but probably they will ask again, roll over the facilities. So technically you won't have an impact on reserves. But then again, come 18th January, that is the day of opening of the parliament, we will have a 500 million sovereign bond payment. So that's that. And then we have the other aspects playing out as well, as Udeeshan indicated, remittances falling. Exports have picked up, and then it could move. Let's say that normalizes the scenario even. You will have imports playing on the other side. And what are the imports that we are going to cut will be the question.
Udeeshan, can I bring you in on what do you think will be a trigger point for an IMF deal? I don't know if there's such a thing as a trigger point. And there's several questions about the potential or the possibility that Sri Lanka's friends, maybe India, possibly China, stepping forward. Are those credible expectations at this point?
So I think one of the reasons why the government has been delaying this going into an IMF program or restructuring, one is that we are depending a lot on this bilateral funding coming through. Second is that the government also understands the consumer pressure that they're seeing with inflation being high. So it's not a great time to kind of pressurize the consumer, especially when there's a pandemic and there's wallet pressure. So that's one reason that they would want to kind of push it back. And also they know the fact that they have one large source which is still not coming into the equation, which is tourism. So from a longer term perspective, yes, there is a solution. You can take the $5 billion tourist earnings to $10 billion. But the issue right now is short-term liquidity. So we need to kind of get our current account deficit sorted out for the short term. And also, because we have this piling up or bunching up of debt repayments, we need to kind of find a way. And for that, we need market access. And we don't have that market access right now. So to facilitate market access, we need someone like the IMF coming in.
Sanjeeva, how logical or how realistic is an expectation that India or China will significantly step in at this point?
So I guess the thinking of the government was probably that if you go to IMF, you will have conditions. Although bilateral funding is relatively expensive, you won't have these conditions. So the government can probably continue their political promises that they gave by keeping some of the taxes low, and it's essentially kicking the bucket down the road. So if you look at Sri Lanka, every government has done their only problem is next 5 years. So I guess we've not had a mechanism that governments being responsible for what they're doing after that, and maybe a max of 10 years, if at all. So that's where the problem lies. After 1978, we've never met a budget deficit target we've given, as in the government has indicated. So I guess it's a matter of being responsible towards what you say, and which has not happened.
Lakshini, again on potential, you think that India or China will help significantly bail us out? What is the likelihood?
Look, I think, even if you look at 21, it has been China that has really come forward and supported in terms of swaps, in terms of loans and whatnot. If you look at the Chinese economy, that's slowing down to some extent as well, right? If you look at India, one thing is that for any further swap agreements or any other loan agreements, especially, the condition was that there has to be an IMF, program in place. So I think, look, these two are, India and China are our best bets. Like I mentioned, I think right now India seems to be, stepping up a little bit more. Nothing has been finalized. That's the key thing, right? There are these, refinancing pipelines. It's very positive when you look at it, but timing is key. And like Udeeshan said, the short-term cash flow issues are the problem. And in terms of timing of going to the IMF, I think, especially in what we kind of said in our 2021 strategy, we didn't expect an IMF talks in the first half of the year, but we did expect them to go to the IMF in the second half. And the fact that that hasn't happened, to me, it looks like the government also wants to get their house in order, because, right now, given where the macro numbers are, I don't think we have a lot of sort of bargaining power right now, given where fiscal numbers are, given where our reserves are. So I think it's a matter of sort of ensuring that there are a bit more credible sort of, lines available, set in place before we go to the IMF. That being said, that is why I essentially expected the budget for 2022 to be much more sort of a more fiscal consolidation plan. So that kind of gives some signals. But I think timing-wise, I think we're honestly a little too late, because a plan also takes at least 6 months. So we're looking at, even if they start talks in December, January, we're looking at any sort of credible financing and the program to be finalized in 6 months' time. And of course, I think if that news does come in, one thing would be to sort of suspend payments, which could actually take place if they do go to the IMF.
Just to roll back and cover something with you that I haven't covered, I have with the others, and that is earnings expectations 2022. Did we discuss what is your forecast on that?
Yeah, I think, more on the lines of it being probably single digits, because, there are some companies, like I mentioned, that will do well, but there are others who will get hit as well. So it's a matter of seeing, I think, picking the potential, picking the stocks, like I mentioned, that will go through the cycles. So your interest rate cycle, your exchange rate cycle, and your inflation cycle. There are winners out there, and I think that's where you need to focus on more than, a very broad type of.
Let's talk about several sectors that, several listed company sectors. One that's really out there is one that's large in the market is financial services. We know that many banks own significant chunks of our commercial debt. Those are, by that I refer to the international sovereign bonds in particular. Should there be a haircut? What happens?
Look, I think if we do go to the IMF and there is debt restructuring, yes, I think a haircut is probably on the cards. There are different ways of doing this, and I think it also depends on what the borrower kind of sort of agrees to and puts forward also depends on what the macro fundamentals are at that point. So like Udeeshan mentioned before, right, if the IMF comes in, they will look at how we can sustainably meet our debt payments. So I think given where we are right now, a haircut is not overthinking it too much. I think it's quite possible.
Udeeshan, Sri Lankan bonds are in the secondary market. I don't have the. I don't know if you know the number right now. It's maybe 65 cents to the dollar, indicating a 35% haircut. We don't for sure know. I don't know if you have the number again. How much of outstanding bonds over the next few years are owned by Sri Lankan commercial banks? But should there be a 35% haircut? What does it translate into, and how does that then translate into valuations of banks?
Yeah, so I think the banking sector valuations have been pricing this in. And if you look at the kind of haircuts that you're talking about, 35% is a bit steep. I think countries like Ecuador only had about a 9% overall reduction in terms of haircut on the bonds, and some of them you can just postpone it. But the problem is actually not the ISBs with the banks. It's actually the SLDBs which were bought at fair value or the face value, right? Because the ISBs, most of the banks accumulated it over the last 2 years. And that was at a steep discount. So it's already priced in. So you don't have to provide for large impairments on those. But on the SLDB component, which is even larger than the ISBs, that is at 100 rupees or face value. So that's where you will have to take a larger hit if it comes to a point of haircuts. But I think the banks have a decent amount of capital buffer. The private banks have a decent amount of capital buffer. But anything in excess of 30% will result in some of the banks having capital calls. So we will have to do equity raisings and so on to kind of manage it. But yes, that's a possibility. But I don't think we need a 30 to 35% kind of cut in terms of haircuts.
If I can come to you, Sanjeeva, banks are trading at 0.6 times, 0.7 times book. Do you feel possible haircut has been priced in? Is that why banks are trading at a discount?
Yeah, if you look at the recovery that we've achieved, should have been priced in to the financial system, which has not. I guess the reason is that. So the reason is that the general investor still believes that we may have to restructure our debt in the absence of the government giving credible forecasts with regard to their inflows.
Lakshini, if I can put the same question to you, banks are trading at a discount. Is this a reflection of a possible ISB haircut? Why are they trading at a discount?
I'll take a bit of a different angle, right? Look, banks have always, over the past couple of years, they've traded at 0.6 times and around there, right? And that's also because of the moratoriums that took place, NPLs, asset quality. There have been different reasons. But I would say, yes, there is concern on especially the large banks because of what they're holding. But I think, like Udeeshan said, that their availability of funds is something that will support something like this, right? I think more than anything, it's the cautionary stance that investors are taking on the banks because they're so cheap right now, and if you look at their earnings numbers, they're doing quite well. But again, it's this cautionary impact, and I think that is also playing in an investor's mind because if you talk to anyone, right, can we pay our ISBs? Domestic banks do own them. That's something that's always talked about. So I think it is cautionary, but I would really think that, with banks trading at 0.6 times, it's still looking quite, attractive at this point as well. Caution is, what will happen next year. And I think that caution is what's keeping investors away from the banks.
Okay. Let's talk about consumer stocks, right? This is potentially anticipating higher inflation next year. And taxes have gone up on companies. Some of these consumer companies rely on a component of inputs. What do you think overall the impact is likely to be on consumer stocks?
So yes, you have price pressures playing out. Wage inflation has not picked up. So you will have some wallet pressure continuing to 2022.
Okay, let me interrupt you first, Sanjeeva. What are the big consumer stocks that we are looking at here? Ceylon cold stores, that sort of thing. Can you give us a list of potential stocks? That
So the usual suspects. I mean, retail companies like CCS, supermarkets, Cargills, and so on. Yeah.
Okay, right. So I interrupted you. Go ahead. So
Right. So I mean, it's now then the other impact that Udeeshan indicated, probably, you have the pent up demand that people may still want to consume certain items that they did not consume while working from home. You have a different mentality when you're at home, and then if you look at December hotel bookings, it's full and completely from local tourists. So that's the demand that's going to be there on consumption as well. So consumption in Colombo will obviously differ from consumption in rural areas because Colombo per capita income is significantly higher. So although you will have an impact, it's probably going to be mitigated from that demand aspect also coming in.
okay, slightly shifting away again from stocks to something a little bit more macro than that, and I'll come to you, Udeeshan, right? It's about the energy sector and the reliability of uninterrupted electricity next year. I think the rains have served, and the hydroelectricity generation is serving well the economy right now, but potentially, the monsoons will be over in several months. And that's about the time we have to pay those bonds also. Is this a clear and present danger?
Yes, there is a danger, but I think that will be key priority for the government. So in terms of even if you allocate in dollars, the first priority is going to be for energy, essentials, things like that. So what I feel is that the government most likely will secure one of the credit lines either from Middle East or India in terms of energy, and that will be a top priority. And I feel that will happen because if that sector is not given the necessary dollars, the remaining every other sector will have repercussions. So you need to ensure that the energy sector is taken care of, and I think the government will do that. And I feel for the longer term, the renewable energy projects that the government is talking will come through. So a lot of investments from that angle to reduce the FX pressure will also kind of come in the next few years. But in terms of priority, I think the dollars will be more focus will be given to energy because that will play a key role in terms of having impact on the other sectors.
Okay, Lakshi, same thing, same question to you. Energy, should there be an energy, do you anticipate an energy related problem next year? If there is, what would be the impact on earnings of listed companies?
There is, look, no-brainer, right? I think it's going to have a massive impact because simple thing, if your factories can't operate, then, how are you going to function? How are your companies going to function? I agree with Udeeshan. I think, look, in terms of our dollar issues, obviously the government's taking a priority list, right? If you looked at the sort of trade numbers, there were a couple of months where they didn't import coal, they didn't import refined petroleum when, there was a need. And I think the rains have been a blessing because that dependence on hydro has increased so much that we didn't really have to import that much coal. So I think that was a key positive for the sort of energy sector for this year in terms of trade as well. I don't factor in an energy crisis right now because I do agree. I think they will sort of allocate the necessary funds needed. And even if you look at global oil prices, the global analysts do say that prices are coming down. So a couple of global analysts expect it to come to about the 66 levels compared to the 75s, even 80s that we saw this year. So I think there may be a bit more leeway for us to continue our fuel imports. And I do agree, I think the essentials will be the ones that will be brought in. Until this liquidity issue gets sorted, I do think that, there will be continued controls on certain places, but that at the end of the day would ensure that there is sustained energy supply in the country.
Sanjeeva, energy would be a key risk factor if it does materialize.
Yes.
You don't, and you feel we can tide through.
No, I mean, see, that will be a big failure from a political point of view. I mean, you are going to, erode whatever the political capital you have. So, if you look at some of the countries that has gone through now, there are some countries that you can only pump 1/3 of your tank. If you go to a full station, even if you have money. So I don't think allowing that kind of a scenario will play out good, given the issues and the invited crises we have already with regard to fertilizer and then gas and all that. So I guess it's a matter of now damage limitation and then consolidating and then moving forward. So I don't think, if any rational person would want to make sure that there won't be any explosion there.
I'll stay with you, and this energy question was one that was on the forum that I took, and I'm taking another from the questions that we are getting. So if anybody out there does want to put questions, now's the time to put those in. Again, I'll qualify it all for you, and that is that it's difficult for you to forecast where the stock market index will land, but do you anticipate next year the index will decline because of the risks, or do you think what do you think will happen on the index? Would it be a 5% or 30% or 70% decline? This is a question. How would you look at it?
So looking from what happened this year or last year, we had a lot of money printed, and then it had to go somewhere, and not the property or not the fixed income markets. But now you have places for that to go. Whether you have enough capacity to print money, again, a big question. So if you assume that you're going to behave rationally and economically sensible way, then there can't be more money printing. And then there's no money to go into this credit. And then you have tightening monetary policies. That means higher interest rates for your credit to pump into even the stock market. And then the market being rebased based on liquidity adjusted stocks. So all this may indicate obviously a significant growth like this, continuing like this. No, it cannot happen. Then you have the earnings slowing down aspect also coming in. Because one of the things that drive the market mostly these days is the sentiment, and sentiment has a lot of its factors coming from earnings, and when these things slow down, you will have a slowing down market.
So this is interesting stuff there. Sentiment is driving the market up these days. We have the potential of debt restructuring and the impacts that will have across the economy. What do you think will happen with the index?
So in terms of the index, if the government and the central bank delay this process of going for restructuring or sorting out the problem, I think the market is going to be inflated and will move even further before they reach a point where things are put back into place. So it will all depend on timing and the government's action. So if they take the action as soon as possible or as fast as possible, I think the market will retrace. And you will see tightening policies coming through. It's not one thing, it will be multiple negative factors sitting at one point, which is, I feel, too much for the market to absorb in one go, and especially in an overheated market. So I feel, but if they delay it and say, for example, they get a funding line and they kind of pass on the problem for another 3-4 months, for that period, I think the market will still kind of continue to move. But it's not something that you can do on for a while. So by the end of the year, I think markets have to adjust back. But within the year, it's going to be a matter of timing. Right? So it can move up before it kind of settles down also.
By what level do you think it'll come down by, if that, or settle down by?
It could even be a steep reduction. It could be even 25-30% if it requires where it needs to be, or to reflect the taxes that will come in also. That's a kind of adjustment that the market will need. Keep in mind that the index has moved from 6,000 or 7,000 level, which was more the sustainable level it was, to about 12,000 almost now. So I think somewhere around 9,000, 10,000 level is a very good level to be in, and is a more sustainable level. But it all depends, because you can't look at the index anymore because it's going to be a complete different index. So when it is retracing, when the index, the low liquid shares fall, the market index is not going to come down as much as what you would have expected to be.
And they're not going to readjust it, for this year as well. So it will be starting from next year. You will have a readjustment. That's it.
Right. So let's talk about the index as it is today, and I suppose this is the baseline that we can use to compare. Looking at the index today, Udeeshan had a point about what level he thinks is a fair price, is a decent level for the index. I don't know if there's such a thing, but what do you think, Lakshini? Will the market decline next year?
Well, that's a good question, right? And like I said, I think it all depends on the scenarios, right? If the government does sort of continue to not have the tight and difficult policies implemented, the local guys will continue, right? And again, it's a question of where do you beat inflation? If all other asset classes do not give you a return to beat inflation, then that interest in the market will still be there, right? And one thing to note, Shamindra, is also foreign sort of inflows into the market have been quite low, right? I mean, it's a lot of outflows. So it's a very domestic investor base right now who are also aware of a lot of these issues as well. So, I mean, like Udeeshan and Sanjeeva both said, it's difficult to gauge because one thing for sure is the level of volatility in the ASPI will be less once this rebasing takes place because all those illiquid stocks will go out. So, I would think the volatility would be less. There will be a pullback in certain times. Definitely, if there is news of IMF, if there is news of fiscal consolidation, there will be pullbacks. But again, to me, it depends on where do you beat inflation after that, right? If your interest rates go up, say, by 200 basis points, that's 2%, right? So I think, yes, there's got to be some correction because there is a lot of sentiment driven and all of that. But it all depends on what this adjusted ASPI would look like next year.
Do you want to put a number on it? Do you think it's possible? I mean, it will have to be a broad range. What do you think?
It is a broad range, and I think not knowing really what that sort of new index would look like and what the volatility would be like, it's difficult to honestly say. Based on what the ASPI is this year, I think, yes, there's got to be a correction. I wouldn't really put a number there, but it's a correction nonetheless. But I think the key thing is that the volatility would be less going from next year onwards. And that, I think, is what's really needed in the market right now.
Okay, I'll stick with you. Question, do you foresee public sector reforms next year? What of those reforms, if at all, do you think will impact asset prices, that is fixed income and equity?
Okay, so public sector reforms in terms of the government giving, look, they've already spoken a lot on putting the clamps down on the state-owned enterprises. And even in the budget, we saw that, right? And giving more accountability to the state-owned enterprises, I think, is a key thing. And that's draining on the expenditure side the government as well. So I think that if that takes place and that actually materializes, would be a positive in order to reduce the government's expenditure side of things. And that is something I expect as well. Certain public-private partnerships, I think, has to be encouraged a lot more than what it is now. And if certain of these asset sales, state asset sales go through, I think that would be a key positive. I wouldn't comment too much on the property market, but there is a positive correlation between inflation and property prices, right? So you would probably see with high inflation expected, elevated inflation at least expected next year as well, first half of next year at least, you're likely to see property being attractive as well. But with a gradual increase in rates, it's difficult to see overall rates being to the historical, 17-18% that we saw. That, I think, will take a bit longer. Yeah.
Udeeshan, I'll come to you. How in this climate, how do you start sort of crafting portfolio strategy? How do you sort of mitigate for the risks that you anticipate? Are there clear places where you should be allocating right now? Where do you start?
Yeah. So as I mentioned, there's two scenarios where it depends on how fast the government reacts. If the problem is dragged, I think one thing that is clear, irrespective of which scenario that takes place, is the rupee depreciation. So that means that you still have opportunity in the equity market, especially on the export companies, because the 15-20% depreciation means especially companies which have a large part of their top line in dollars and the costs in rupees, there'll be a huge improvement in terms of earnings. So export companies definitely will be a good pick if you're sticking on to equities. You can look at the more defensive counters if you are getting close to a cycle of restructuring and so on. But I will also move a little bit of my portfolio more towards the real estate front. And I feel that there is opportunity still there, given that the prices have not steeply increased, and also land to even completed buildings or any kind of commercial property will have a lot of value, given that inflation, it is a good inflation hedge. And if you look at countries which have gone through similar cycles, property has been one segment which has really outperformed in this kind of environment. So I think investors should look at increasing their exposure to real estate, but the problem is that it's not an accessible asset for everyone. The other asset class that people can look at, and especially this is also limited to people who have the capacity, is the private equity front. So you might be shifting from your public equity to private equity investments, which is basically you're holding on to real investments. So in a situation where inflation is increasing, you need to hold on to real assets. That is where we don't have much exposure that we could take to commodities in Sri Lanka. So the ones that you're left with is either through real estate, or I feel is private equity, which is a proxy that you can take for real estate.
There is not much potential for fixed income in a portfolio next year, you think?
In terms of fixed income, the initial bit, so I wouldn't ask people to lock in funds right now. So I will still say short. If I'm staying in fixed income, I will stay in the fixed income mutual funds. But as when rates start moving up, it won't be gradual increases. It will be steep increases you might see in the secondary market. At that point, you might be able to kind of shift to bonds and so on at that point.
Okay, Sanjeeva. So, I mean, Udeeshan's not laying up a lot of potential options here, right? He's, and I'm not asking you to comment on what he's saying, but export companies, fixed income is not an option. Real estate is potentially the only other thing if you have the allocation for that sort of thing. That sounds like a lean year, 2022.
The economic clock says once the equity market crashes, you have the property market going up. So I guess the thinking has nothing to be challenged.
Besides, for most people, equity is an accessible asset class.
If you look at the market this year, right? Around 70 or 60 to 70% of the market was driven by like 5 to 6 stocks.
Right.
So, when we say the correction also should happen to these artificially inflated assets. The companies that went on certain rumors, except for 1 or 2 companies that had real fundamentals playing out. Certain companies that, appreciated based on rumors, and once the minority shareholders get to know the reality of these companies, then you will have these corrections happening. Whether it comes down by 20% or 10% will obviously depend on the liquidity adjusted factor, which we really don't know, because I guess, if you look at a similar correction, it has to happen. But now that we are going to adjust it to liquidity, these companies are illiquid. So once they crash, the market may not come down significantly. So it's a kind of a smart move to not reduce the market index in a way, but then again, you may have to look at the real valuations, because none of the foreigners are coming in right now. Why? Because they are going to lose because of a not fair valued currency. So, if you are looking at maybe 20% or 25% downside for the currency, that means they're losing that amount in their investment. So, till that is fixed, Sri Lanka is not going to see these solid investments coming in. And by saying that we are giving 10 rupees or anything is not going to fix the problem. You have to really address the issue to get these investments in.
And if you had to allocate some money right now, what are the opportunities in equity? Are there opportunities in equity?
Yes. So, as we indicated, so there were like a handful of companies that went up. And you have most of these companies that that did not appreciate. But then again, there are pending risks, as we indicated. So if the government understands and then fix the problem tomorrow, then you will have a awesome year next year, because everything has been adjusted into even December quarter earnings, right? So why we are not saying that is obviously we don't expect it to happen tomorrow. They really love the practice of kicking the bucket down the road. That has been the case with regard to delaying getting IMF also, because IMF coming in will entail them to let the currency depreciate, have a more autonomous monetary policy, and then stop printing money, and then may have to kind of adopt fuel pricing or energy pricing strategy and all that. Obviously with timings also in play, given that you can't really impact the consumer wallet right now, but IMF will have a plan, but which will require the government to have more discipline, which will erode some of their political capital, because it will be essentially going against what their political promises were at the outset.
Lakshi, same question to you, and I'll sort of push you to be a little specific. If you were to allocate some money into assets, where would that money go to right now?
Look, I would like Udeeshan said, I wouldn't lock in my money, right? I would go short term. And I mean, right now, even if you look at mutual funds, money market funds, there are some that are like quite attractive. I would go short term, especially into these sort of money market funds, for example. I would play a little bit into the market because I do see opportunities. I do see some undervalued counters which do have potential. And I would put very little on fixed income right now because it would be very short term if that is the case. If there is an opportunity to buy physical commodities like gold, I would actually go in there. If you're giving me enough money to buy property, I'll definitely do that as well.
Okay, so if property were a difficult asset class to access for most people, in equity, in what areas broadly do you think there's potential to deploy capital right now?
In the equity market,
in
sectors.
The equity market, yeah.
Right. Look, like I said, those that are going to do well in the middle of a currency depreciation, so export-oriented stocks, companies which have local LKR costing. You would go into, given it's an inflationary cycle, you would go into some of the stocks which actually do well during those high inflation times. And you would go into certain stocks which are very defensive as well. So, even if, no matter what happens in the economy, these stocks that, are solid and will stay fundamental, and their fundamentals, there are some stocks, right, that are quite fundamentally strong, but yet are not being picked up. So I would look at the longer term trajectory as well and lock in some funds there, given at what cheap valuations they are right now. And that's the way I would go about looking at it.
Udeeshan, there are some companies in Sri Lanka that potentially telcos, even conglomerates that have foreign currency liabilities, and they don't have significant export earnings, so they potentially carry a large forex risk. Should this materialize next year, do you anticipate telcos and even conglomerates will take a beating in earnings?
So in terms of the telcos, the listed telcos have been reducing their FX liability exposure. So they've brought it down significantly over the last 24 months, anticipating this cycle. So the kind of depreciation impact you've seen in the recent past is not going to be there with the telcos, especially because they've built in that reserve, they've built in the kind of USD reserves to kind of manage that situation, right? So you're not going to see that kind of impact which you would have seen for a 10-15% depreciation. On a conglomerate perspective, actually most of the conglomerates are in a positive territory when it comes to the rupee depreciation. So a lot of them have foreign assets. It might not be direct exposure. They have exposure to companies like tourism, in tourism. So one sector I would think will do really well is tourism, especially if there's a 15-20% depreciation. I think Sri Lanka will be a very cheap destination, and that's going to bring in a lot of money. And the numbers coming in right now are kind of very encouraging. We're seeing about the country doing about 30 to 35% of pre-COVID arrivals, and Jan to March forward bookings are at least 50% of our pre-COVID level. So tourism is another sector, and that's one sector that can really change Sri Lanka's outlook in the long term.
Sanjeeva, can I ask you about particular sectors? Where do you think money can go to right now? Are telcos risky? I mean, they're a fair chunk of the market. Are conglomerates risky because of the forex risks they still may have in the balance sheet? What do you think?
So, as indicated, conglomerates with tourism angle will have a recovery aspect coming in. And then we see discussions of casinos also likely to come into play from early next year. So that will be again a positive thing for all these tourism related companies and conglomerates as well. And then telcos, as Udeeshan also indicated, most of these companies have been reducing their external debt exposures. It has been the government who is not allowing them to repay it in full, although they wanted that. But then again, you will have some of their capex getting delayed if there is a dollar crisis, which is out of their control. Anything out of these companies' control, which will be at the control of the government, will have, we already see these things happening from a supply chain angle for certain construction companies as well. So, but now, so if you go by a scenario of they will be managing it without a significant crisis, yes, you will have construction and then in addition to the sectors indicated, right, export oriented and all that. Once the correction happens to the financial institutions after the haircut or managing the situation, then you will have these also going up, because that technically represents the economy. So economic recovery will have a complete correlation, a positive correlation with the financial sector, especially with the banking sector. Interest rates going up also may mean their margins improving. So yeah, you will have a positive impact coming in. But then again, depending on how these taxes are applied, now we believe that social security levy will be applied as on the value added, but if it is applied on the revenue, it will be a complete different scenario, which I don't think really make economic sense. But yeah, so thinking from a rational point of view, there are these sectors that are indicated which will benefit.
Do you see any potential black swan events, positive or negative, that we should keep an eye out for? They are not realized risks, but rare but possible.
It's really difficult to tell, Shamindra, because the point is that the government is delaying the obvious, and we, as analysts, we really don't understand why. I mean, we are not politicians, so I'm sure it is from a political angle. This is not happening, but yeah, these things should not be delayed. Because you as a government will want your people to continue eating, and yeah, so you can't delay the obvious. You have to get it fixed, unless you really have a plan that was not indicated to us and which will obviously fix the situation.
Is there a plan that you see that is credible enough, or should the government move here? Can this be a big risk factor that the government stays put on? And I think we are discussing debt restructuring here.
So I think they can buy a bit of time through this bilateral borrowings or swap, which are all short term in terms of nature. So it's a matter of buying time, but I think you can't postpone it for a long time. For even tourism to kick in, it's not going to be overnight. Might be 2023-24. So short-term liquidity is a concern, and we really don't see anything material happening. So from the government perspective also, there's nothing too much that they can do at the moment. So they are doing whatever they can in terms of allowing market forces to determine prices, they might probably allow things like gaming coming into operation. allowing private parties to set up terminals, bringing foreign partners in for PPP projects. So they are trying whatever they could do, but the problem is the short-term thing. Sri Lanka's problem can be solved. It's not it is not a problem that cannot be solved as such. It's just that for the moment, if we get through this next 12 to 24 months, I think we are in a very good footing. If tourism kicks in, the ports kick in, if we can kind of put the SOEs back into place, sell out a few, get the non-strategic ones out, I think we'll be in a very good position. Our economy is very small. The potential that Sri Lanka has to grow is enormous. So it just needs a corrective decision that we need to do for the short term. And we've seen countries which have gone through this phase, 24 months down the line, they really turn around. And this is possible with Sri Lanka as well. So it's just this year, go through a phase of consolidation and corrective measures, which will put us in a good place for 2023.
Somebody comments that 3Q GDP is out, it is minus 1.5. I think this is, we'll start wrapping things up, Lakshini. We'll start with you, closing thoughts.
Yeah, look, I mean, that tells you, right, where momentum was in the third quarter of the year. But looking ahead, I think we expected 3Q to be relatively flat or even negative. But 4Q, I think, is where the numbers are going to be, because you saw the sort of resumption of activity, you saw tourism pick up, so your manufacturing and your services sectors probably did quite well in the fourth quarter. And the third quarter did have a lot of restrictions, travel restrictions, tourism was really bad, hit quite a bit. So, that's probably where that negative number came. But look, I think I have to agree with Udeeshan. I think it's the next 12 to 24 months that is really crucial, right? I think we've come to a place where we need to sort out our short-term funding. In the absence of that, I think going to the IMF is inevitable. Could the government have done it without the IMF? I think if sort of these funding lines came in, yes. If we didn't get further downgraded, yes. But given where we are right now, it's very difficult. But that being said, the longer-term trajectory and the longer-term status quo of Sri Lanka still remains. It's just that COVID hit, we couldn't go to international markets. Anyway, we had a twin deficit and everything kind of piled up, right, with tourism and tourism not sort of continuing. And that came from the Easter Sunday bombing. So it was a lot of sort of things that unraveled the past 2 years. I think, again, it's a matter of, sort of taking a relook at everything, tightening our belts for, what's to come next year, and sort of looking at further onto the long-term positives for Sri Lanka.
Great. Udeeshan, final thoughts.
I think this 1.5% negative growth is also because of the base effect from third quarter last year. Third quarter last year was a very good quarter because second quarter was badly hit. So that's also a reason why the numbers are not reflecting the improvements. Because corporate earnings have been good for the third quarter. So certain segments have been taking a beating in the third quarter. But fourth quarter, we feel that there will be an uptick and with tourism also coming into play. But overall, I think it's a matter of it's a short-term issue, as what Lakshini also mentioned. If we can get through this problem, I think we have the best location, which strategic location, the resources, the people to kind of get Sri Lanka back on track. So that would be my final message.
And Sanjeeva, your final thoughts for today.
Yeah, so I guess the GDP minus number is we had a lockdown during that period. We were speaking to a massive, construction cement company, listed cement company, this morning, and they were saying that they had to incur distributor cost also. So so you have to take your margins get compressed. So these kind of issues were there, which are not going to be there. And if Omicron does not play a massive role here, and then we are headed to a okay recovery, then you will have tourism taking the baton, and till that time the government may have to manage, and that's where the silver lining is. So managing next 12 months, especially managing the key issues will be key, and then you will have Sri Lanka at least having a plan towards moving back to its steady state economic growth.
Okay, so thank you, Lakshini. Thank you, Sanjeeva. Thank you, Udeeshan. That's been a great conversation. We were discussing how potentially you can allocate a portfolio in 2022. It is certainly going to be a challenging year. It's going to be a new experience potentially for Sri Lanka's economy if it decides to take the path of restructuring its commercial debt, basically its international sovereign bonds. Our panel is in agreement that is imperative that we do it, and any other course of action or the current course of action of not committing to a clear plan on that front is risky. So hopefully we've added something for you to think about portfolio management in 2022, and thank you very much for joining us. Until next time, it's goodbye from Echelon.